Hey, Dan Passarelli here. I wanted to give a brief video about why tech it has been selling off. Yesterday we saw the NASDAQ, the NDX, fall about 400 points, over 400 points. That was more than a 2 standard deviation move. So that was a pretty big drop. Now, a lot of people have been asking me, well, why? Why is that? And it's for 2 reasons. Well, actually, there's 2 examples of the same reason. One is yesterday we saw the treasuries really sell off pretty hard. And when that happens, there's an inverse relationship between bonds and interest rates. That means interest rates have already started creeping up. Now, that said, that's been the second reason that's been sort of telegraphed by the Fed. The Fed has said that they're going to start raising interest rates this year. And when they do, they expect to start paring back their portfolio of securities as well. And so when they do that, that is going to raise interest rates because A, they're raising interest rates, but B, selling those securities can put some downward pressure on the market in and of itself as well. So that's why tech has been selling off. And to be fair, it's not necessarily just tech; it's growth stocks, and tech falls into that broader category because growth stocks, like tech stocks, rely very heavily on being able to borrow cheap money. And when you can borrow money at basically a zero real interest rate, or in some cases maybe even less than a zero interest rate, when you factor in inflation, that makes for a really, really good environment for tech. But when interest rates go a little bit higher, the market tends to move more towards what we call cyclicals, which are just sort of more traditional companies, physical goods, things that don't have that same reliance on aggressive growth through borrowing cheap money. This is Dan Passarelli of Market Taker Mentoring. Trade smart.